Hi everybody, this is James Tompkins and welcome to Lecture 11 of the International Finance Series, where today I'm going to discuss foreign exchange hedging. But, as you know, if you've been watching these series, hope you're not too tired of this, I always like you to know why we're doing what we're doing, as opposed to, hey, this is in Chapter 6 and Chapter 6 follows Chapter 5. So in any case, the overall theme of this class was what? International financial principles as it affects firm value. And value is a function of risk and return. And what element of risk have we been looking at that one might relate internationally? Exchange rate risk, right? So in other words, my goal is to get you to not memorize but understand why the dollar goes up and down in value. And we've used that as a benchmark or a platform from which to also look at other or understand other reasons why currencies go up and down in value. You know, why does the Hong Kong dollar not change, and why did the Zimbabwe dollar basically go bankrupt, etc., etc. So in any case, the second half of this class is going to look at managing this risk and managing it not only in the short term but also the long term. And in Lecture 10, we looked at foreign exchange markets, and we're going to use some of the knowledge of what we learned in that, in other words, some of those markets in this lecture to manage exchange rate risk in the short term. And that comes under the heading of foreign exchange hedging. So that's why we're doing what we're doing. So, agenda. Not complicated. Basically, I'm going to start off with a little bit of an introduction, and then we're going to go through a hedging example. And what I'm going to do is I'm going to pick a really simple example, and the goal will be just to go through a whole host of alternatives as we're faced with potential exchange rate risk in this example. So that way we'll see the pros and cons of the different alternatives that we highlight. So first of all, what is the goal of hedging? Obviously, this is definitional, right? So, you either know it or you don't. But any thoughts? Well, basically, it's to eliminate or reduce risk. And in the context of what we're talking about, it's going to be risk associated with foreign exchange transactions. Now, when you think of risk, is risk about the expected or the unexpected? Well, pretty much the unexpected, right? I mean, so for example, in your lifetime, has the sun ever not risen for you in the morning? And I don't mean whether you see it or not. I mean, you know, even if it's cloudy, has the sun ever not risen for you in the morning? It hasn't, right? So in other words, you know, what you expected to happen has always happened. And so, in other words, nothing unexpected has ever happened when it comes to the sun rising, right? So when you think of this, at least based on historic experience, when you think of this notion of the risk associated with whether or not the sun will unexpectedly not rise, you would say that risk is what? Probably zero, right? And so basically risk is about the unexpected. So we said the goal of hedging was to eliminate or reduce risk associated in this example with foreign exchange transactions. So when we think about hedging foreign exchange transactions, are they providing you protection, if you will? You know, this is, you know, managing or eliminating or reducing this risk. Are they providing you protection against expected exchange rate changes or unexpected exchange rate changes? Unexpected, right? I mean, first of all, does the market have an expectation of what the exchange rate will be for, say, the yen in 3 months? It does, right? I mean, we saw that in the last lecture. We saw that with the forward market, with the futures market. You know, in the same way that the market says, hey, Apple stock is worth, $550 a share today, which is based on its expectations of both cash flows and or risk inherent in those cash flows, okay, the market also has expectations of what an exchange rate is going to be, say 3 months down the road. And so when it comes to hedging, I mean, I'll give you an example, okay? Suppose I want to make this up. Let's say right now the exchange rate for the euro is, say, a dollar 35 per euro. Okay, so let's say the exchange rate today is $1.35 per euro. And let's say today that the market expects the exchange rate, say in 3 months, and again I'm making this up, okay, is $1.40 per euro. So in other words, imagine that the futures price today, you can go to the Wall Street Journal or whatever and look up the futures price or the forward rate, and the market's basically saying, all right, well today we expect the exchange rate in 3 months to be $1.40 per euro. So in other words, does the market expect a change in this exchange rate? They do, right? That they're actually expecting the dollar to what? Weaken or strengthen? Weaken, right? They're expecting it to take more dollars 3 months down the road to buy a euro, and therefore they're expecting the dollar to weaken. So when it comes to hedging, is hedging going to eliminate this difference, the difference between the $1.40 and the $1.35? It's not, right? Because that's what's expected. But suppose the actual exchange rate, would it be a huge coincidence if the actual exchange rate was the same as the expected exchange rate 3 months down the road? It would be, right? I mean, that'd be like you investing in Apple stock, and maybe Apple's trading at $550 a share, and you expect it to be trading at $600 a share in 1 year. Well, 1 year from now, would it be a huge coincidence if Apple was trading at exactly $600 per year? It would, right? So same thing here. I'm going to make something up. So suppose that the actual exchange rate in 3 months is $1.42 per euro. Okay? So here we have today's exchange rate. Again, all these numbers are made up. Here we have the market saying today, hey, in 3 months we expect the exchange rate to be $1.40 per euro. And imagine I have a crystal ball, and 3 months down the road, the actual exchange rate is $1.42 per euro. So if you are going to completely eliminate exchange rate risk associated with hedging, then what difference would you be protecting yourself against? Well, how much of this guy, the $1.42, is unexpected? The difference between this $1.42 and the $1.40, right? Because $1.40 was what was expected. $1.42 we're imagining is what actually happened. So hedging would protect you against the unexpected, or in other words, the 0.02. The unexpected additional amount that the dollar, weakened or strengthened? Weakened. So bottom line is that hedging does not provide protection against expected exchange rate changes, but rather unexpected. So let me bring up one key principle behind hedging. And look, I'm probably being way simplistic here, but I like to keep things simple. All right, if it's not simple, it's over my head. All right. So, and I'll set this up with a situation, an example. In fact, this is going to be our example when we get to it. Imagine a U.S. businessman or woman or whatever owes a Japanese supplier 100 million yen in 90 days. Okay, so because the Japanese is supplying with something. Okay, now would you have created, if you're the U.S. business person, would you have created an accounts payable or an accounts receivable if you're going to owe 100 million yen in 90 days? An accounts payable, right? I mean, there you have the accounts payable, and you owe 100 million yen in 90 days. Now, next question. The amount that you owe in dollars, would it depend upon the actual exchange rate and therefore be subject to risk? It would, right? And so, I mean, to the extent that, yeah, the market has an expectation today of what the exchange rate will be in 90 days. And so therefore you have an expectation today of how much you'll owe in dollars in 90 days. But if you just waited and you saw what the actual exchange rate was, would you be subject to paying unexpectedly, or likely be subject to paying unexpectedly more dollars or fewer dollars? You would, right? So here's my question. What in principle could you do to avoid any unexpected exchange rate payments? Okay, so in the context of this balance sheet, what could you create such that in the end you would not pay anything unexpected? Well, basically, what you could do is create something equal and opposite on the other side of the balance sheet. So in other words, with your transaction, if you owe 100 million yen, if somehow, and we'll get, and this is where we'll get into various alternatives with our example later on, but if somehow you could create something equal and opposite on the other side, we'll call that our hedge, then is it going to matter what the exchange rate is? It isn't, right? Because you could take the 100 million yen that is owed to you in 90 days, and could you then use it to pay off what you owe in 90 days? You could, right? And so basically that's, if you will, the one key principle in hedging. You know, create something equal and opposite on the other side. So a couple more questions. In principle, does hedging apply just to the short term, say a year or less, or could it also apply to the long term? Well, in reality, it could apply to both the short and long term, okay? Now, what we're going to be talking about today is short term. And the reason we're going to be discussing short term is because we're going to be using these markets that we learned last time. And you remember what those markets were? Well, we had first of all, what happens at a market? You buy and sell stuff, right? So what kind of I'm talking about foreign exchange markets. So what's being bought and sold? Currency, right? And so we talked last time about the spot market and you remember? Forward market, the futures market, the options market, and all of those are short term. I mean, there's some exceptions, like options, they have what's called leaps, which goes beyond a year, but they're generally pretty thinly traded. And in any case, we're going to be talking about using these instruments for a year or less. And we're going to associate it with a specific transaction. I'll tell you what I mean by that in a minute. But hedging can also, in principle, apply in the long term. Maybe you've heard of something called a natural hedge. Does anyone know what a natural hedge is? Well, it might be that you have operations, let's say a ski resort. Maybe you have a ski resort in Vail, but you also have a ski resort in Switzerland. And owning a ski resort, is that short term or long term? That's long term, right? So we'll be looking at managing this risk and actually taking advantage of risk opportunities that exist in the long term, but not today. Today we're going to talk about the short-term management of exchange rate risk. And in particular, as I mentioned, we'll be talking about something called transaction exposure. And what is transaction exposure? Well, it's not complicated. Basically, we engage in a transaction that, of course, in our case, involves paying or needing to pay with foreign currency. And so what risk is associated with the fact for this transaction that might make you pay more, say from the US perspective, more dollars than expected or less dollars than expected because of unexpected movements in the exchange rate risk. In the exchange rate. So here's a question. Can you be subject to transaction exposure when there is not a credit transaction? In other words, if payment is immediate? You can't, right? Because if payment is immediate, are you using today's exchange rate? You are, right? And so is there any risk or uncertainty about what today's exchange rate is when you say, all right, hey, give me my widgets now and I'll pay you now? Is there any uncertainty about how much you'd be paying, whether it's in yen or dollars or whatever? There isn't, right? So when it comes to creating risk, time has to pass for there to be a situation where unexpected stuff happens. So let's get into a hedging example, okay? Imagine an American firm wants to buy widgets. Now, you guys like the real world, right? I thought so. And so guess what? Widgets are real, all right? I took the trouble of looking it up. And if you look up right here, widget, and if you look up what at least one of the meanings of a widget is, I'll give you a couple. Any small mechanism or device, the name of which is unknown or temporarily forgotten. Well, we're somebody who's not buying something unknown, we're buying widgets, something that is known, right? A small device in a beer can, which, when the can is opened, releases nitrogen gas into the beer, giving it a head. All right, so that's what we're buying. Okay, so we're talking real world stuff here. Okay, a couple other things I need to make up. All right, so we're buying widgets, Japanese supplier, cost us 100 million yen, and it's due in 90 days. Okay, so we want the widgets today, but we want the credit. And by the way, not an unusual way to do business. So in other words, hey, give me my stuff now, my widgets now. I'll then add value to it somehow, and then I'll sell it, and then I'll get my money, and I'll use that money to pay you. Okay, so we want the credit. Now imagine, here's some interest rates. We'll be working with these as we go through the various alternatives. Imagine the US 90-day T-bill rate is 3%. The Japanese 90-day T-bill rate, 2.5%. The US prime rate, 6%. Japanese prime rate, 4.75%. By the way, what's the difference between a T rate or a treasury rate and a prime rate? Well, who's doing the borrowing when, for example, you invest in a US T-bill? The American government, right? They're borrowing money. Okay. What about the prime rate? Who's doing the borrowing there? The bank's most creditworthy customers. Okay, so the prime rate is the rate at which banks will lend to the most creditworthy customers. All right, couple other things. Imagine the spot rate today is $0.009988 per yen. Imagine the 90-day forward or futures rate is $0.01 per yen. So in other words, what does that mean? That means that today the market is saying, hey, we have an expectation that in 90 days the exchange rate will be what? $0.01 per yen. Now this and this, the spot and forward and futures, is that data that is available in the real world on a second-by-second basis? It is, right? All you have to do is just get on your computer and you'll see what the current exchange rate is right now, and you'll see what the current futures or forward rate is right now, etc., etc. But to create risk, the only part that's imaginary in this example is I'm going to have to make up what the actual exchange rate is in 90 days. So obviously I don't have a crystal ball. I don't know what that is for real, so I have to make that up, right? So imagine that in 90 days, either the yen is going to go to $0.012, so $0.012 per yen, or $0.008 per yen with equal probability. Okay, so in other words, that's the crystal ball part of it. That's the unexpected part. Okay, the market's expecting $0.01 per yen, but maybe the yen unexpectedly what with this number here? Is the yen unexpectedly appreciating or depreciating? If the yen is expected to buy you $0.01, but in the end it actually buys you $0.012, has the yen unexpectedly appreciated or depreciated? Appreciated, right? Okay, so there's the example. And like I said, what we'll do is we'll go through a number of different alternatives. Okay, so alternative number one. Let's say we buy the 100 million yen today. So at today's exchange rate, of all the various exchange rates I listed you, I gave you the spot rate, I gave you the forward or futures rate, I gave you the actual exchange rates with 50-50 probability in 90 days. What exchange rate would I need to determine how many dollars I'd need to buy 100 million yen today? Well, the spot rate, right? Today's exchange rate. I'm changing the money today. All right, so there I have, that would mean I'd need $998,000. And so my question is, well, all right, if I now own the 100 million yen today, can I use that to pay what I'll owe in 90 days? I can, right? But let me ask you this. If I got the 100 million yen today, what would I do with it? Would I put it under my mattress, my corporate mattress? I wouldn't, right? I mean, that wouldn't be very smart, right? So the question is, do I really need the 100 million yen today? Do I really need the whole 100 million yen today? No, I don't, right? I mean, what I could do is I could get a little bit less than that today and invest it, right? Such that by the time the investment grows, it will have grown to 100 million yen. Now, at least that's better than putting it on my mattress, right? So what would I do? Would I look for a high-risk investment or a low-risk investment? Well, hopefully something as close to zero risk, right, as possible, because the whole point of hedging is to do what with risk? Eliminate or reduce risk. So what is the most risk-free thing that you can think of what I could do with yen? Well, lend it to the Japanese government, right? It's buy a yen T-bill. So in other words, what I could do is I could buy enough yen and lend it to the Japanese government at 2.5%, such that in 90 days, it would grow to 100 million yen. So that way, in 90 days, I'll be owed 100 million yen. And if that's the case, can I use that to pay what I owe? I can, right? And by the way, by doing that, will we have created an accounts receivable? We will, right? Because just to remind you, with our widgets, okay, we owe 100 million yen in 90 days. Is that our hedge or is that our transaction? It's our transaction, right? And have we created an accounts receivable or an accounts payable with our transaction? Well, we've created an accounts payable, right? So here we owe 100 million yen in 90 days. Well, if we go through this alternative number one, okay, we'll be owed 100 million yen in 90 days. Is that an accounts receivable if somebody's going to owe it to us, in this case the Japanese government, or is that an accounts payable? Well, it's an accounts receivable, right? So in other words, what we've done is we've created our hedge on this side. We've created an accounts receivable. So let's get into the numbers, okay? So we don't want 100 million yen today. We want a little bit less, such that we'll use it to buy a Japanese yen T-bill, and at 2.5%, we want that to grow into 100 million yen. So if we look at how much we need today, let's say X is what we need today. At 2.5%, 90 days later, we want it to grow into 100 million yen. So if I go through the time value of money stuff, this is basically a future value formula, right? And by the way, if that's not clear to you, you can always go to, I think it's lecture 2 of the, not international finance, but my corporate finance series, and get a thorough not memorization, but really thorough understanding of time value money. So in any case, what this shows us is that we would need about 99.4 million yen today, such that at 2.5% it would grow into 100 million yen. And so therefore, if this is the amount of yen I need today, can I calculate how many dollars I need today? I can, right? What exchange rate would I use? Would I use the future or forward rate? Would I use the spot rate today for an exchange today? Hint, hint. That's what I'd use, right? So basically, using the spot rate, I'd need almost $1 million today. I'd need $993,000 today, roughly. So if we look at what's going on, we would need $993,000 today. We'd convert it in today's exchange rate to about 99.4 million yen. And then what would we do with it next? We'd lend it to the Japanese government, right? Whose T-bill rate at the time is 2.5%. And then what would happen? Well, in 90 days, it's payday for us, right? They would owe us 100 million yen. So that's basically the transaction involved in alternative number one. Now, can you think of any advantages with this first alternative? Well, are we perfectly hedged? We are, right? I mean, because again, here's our transaction. This is the widgets. And here's our hedge, right? We've created an accounts receivable. So do we care whether the exchange rate goes to $0.012 per yen or $0.008 per yen? In the end, will we have paid a known quantity for the widgets in dollars? We will, right? So an advantage is we're perfectly hedged. Now, can you think of any disadvantages? Now, one thing that you might say is, well, we gave up the opportunity to maybe unexpectedly pay fewer dollars than expected. And that's true, but then at the same time, have we also given up the opportunity to pay more dollars than expected? We have, right? So let's just assume throughout all these alternatives, when we're talking about advantage and disadvantage, that those two offset each other. In other words, when we're talking about risk, is risk unexpected dollars both in the happy face direction and the sad face direction? It is, right? So we'll assume those always offset each other. But what's another disadvantage? Well, how many dollars did we have to come up with today to engage in this hedge? Well, we had to come up with practically $1 million, right? But did we want credit? Yeah, we didn't want to have to mess with coming up with any money, especially not $1 million, for another 90 days. And so an advantage of this first alternative is, yes, we're perfectly hedged, but a disadvantage is what? Well, we gave up our credit advantage. So that's alternative number one. Let's look at alternative number two. Okay. Number two says you can just accept the risk and purchase the currency on the due date. Okay. So let's see what happens. Okay. Imagine the yen unexpectedly appreciates, right? Because how much were we expecting the exchange rate to be? Okay, if I draw this out, we were expecting the exchange rate to be $0.01 per yen. Okay, this is what we were expecting, the $0.01 per yen. But either the yen would unexpectedly do what here? Appreciate or depreciate? Appreciate, right? Buy you more dollars than expected. Or the yen would unexpectedly depreciate. Okay, so let's look what happens if we just take on the risk. Okay, so if the yen appreciates to $0.012 per yen, then how much will we owe in yen? Well, we owe 100 million. I mean, how much will we owe in dollars? We owe 100 million yen, right? But if the actual exchange rate in 90 days is 0.012 and we just wait 90 days, we don't do anything, well then we're gonna pay $1.2 million. Now, is that happy face or sad face? Well, we have gone, yay, glad we took on this risk, or we would go, oh man, I wish we hadn't taken on this risk. Well, that's sad face, right? And how would I know that's sad face? What calculation would I have to do? Well, I'd have to compare it to what we were expected to pay in dollars. Now, I know how much I have to pay in yen, 100 million yen. What exchange rate would I use at time zero today to figure out how much I'd be expected to pay in dollars? You want multiple choice? Would I use today's spot rate? Would I use the expected exchange rate, i.e. the forward or futures rate? Well, I'd use the expected exchange rate, right? And so basically, I was expected to pay $1 million. But if I take on the risk, in the end, I would pay 1.2 million. So if the yen unexpectedly appreciated, would I have lost or made money by accepting the risk? Lost, right? And how much would I have unexpectedly lost? Well, we expected to pay $1 million. In the end, we would actually have to pay 1.2 million. So how much of that is unexpected? 200,000, right? Let's look at what happens when the yen unexpectedly depreciates. Well, how much would we owe in dollars? Well, in 90 days, if the exchange rate is 0.008 per yen, and we owe 100 million yen, then we would pay $800,000. So would that be happy face or sad face? That'd be happy face, right? Because how much were we expected to owe in dollars again? $1 million, right? So therefore, would we paying more than expected or less than expected if we took on the risk and the yen depreciated? Less, right? Because we were expecting to pay $1 million, but in this example, we would only pay 800,000. So we would have made 200,000. So happy face or sad face? That'd be happy face, right? So what I want to do now is get across some language. You know, this concept of long and short. And the reason that I want to do that is because it'll probably be easier to figure this stuff out as we go forward. Okay? So here's our transaction. Okay? And we owe something. And when you owe something, as opposed to when you own something, are you long or short? You're short, okay? So for example, if I buy 10 shares of Apple stock, I own it. So would I be long Apple stock or short Apple stock? I'd be long Apple stock, right? But in this example, with our transaction, with our widgets, okay, we owe 100 million yen. So are we long or short yen? We're short, right? So what I want to do is look at when you're long and you're short and things go up and down in value, whether you make or lose money, okay? So when you're long something and that something goes up in value, have you made or lost money? You've made money, right? So for example, if you buy 100 shares of IBM at say $80, are you long or short IBM stock? You're long IBM stock. That's what we're used to. And so suppose the price now goes up to $90. Is there going to be happy face or sad face? Happy face, right? So when you're long something and that something goes up in value, you've made money. So in this example, we buy 100 shares at 80. So it basically, we have something that's valued at $8,000 when we buy it. and then it goes up to $90. Now it's valued at $9,000. So we've made it $1,000. Okay. And what if IBM had gone down in value? Suppose it had gone from 80 down to 70. Would you have made money or lost money? Lost, right? So this is what we're used to. When you're long something or when you own something and it goes up in price, you make money, and when it goes down in price, you lose money. So that's the easy thing. That's what you're used to. Okay? Now, what about the other thing? What does it mean when you're short 100 shares of IBM stock? Well, now short is the opposite of long, right? So if you're long, you own the stock. But if you're short, do you owe the stock? O-W-E? You owe it, right? In other words, you borrowed it. So when you're short 100 shares of IBM stock, basically you've borrowed 100 shares of IBM stock. So let's say you short 100 shares of that stock at $80. Okay? So what that means is that your account literally, it's like going to the bank and borrowing $8,000. Okay. Now, if it now goes up to 90, and it's time to repay that 100 shares, then how many dollars will you have to come up with to get those 100 shares? Well, you'd have to come up with $9,000, right? And so it's like going to the bank in this example, and you borrow $8,000, so you put that $8,000 in your pocket, and then you keep it, but when it's time to pay it back, you have to come up with $9,000 to repay what you borrowed. So when you're short something, and that something goes up in value, have you made or lost money? You've lost money. So again, re-emphasize, you borrowed 100 shares at 80, your account went up by $8,000. Then it came time to return the shares, but now you're returning them at 90, so your account goes down by 9,000, and so you've lost money. And so similarly, so when you're short something and that something goes up in value, have you made or lost money? You've lost money. But when you're short something and that something goes down in value, have you made or lost money? You've made money, right? So for example, in this case, imagine that IBM stock had gone down to say 70. Well, then you would have only needed, instead of 90, you would have only needed $7,000 to come up with these 100 shares. And so you will have made money. So that's the concept of short and long. So short is the opposite of long. Long is what you and I used to. Hey, you buy Apple stock, it goes up in value, it's happy face, goes down in value, it's sad face. The short, the rules are completely reversed. So now let's apply this to our transaction. Are we long yen or short yen? Well, we're short yen, right, with our transaction. So we were short yen, and when the yen unexpectedly appreciated, okay, so when you're short something and that something goes up in value, then would we make or lose money? We lose money, right? Do you remember how much we lost? We lost 200,000, right? Why? Because, again, if we took the risk, we were expected to pay how much? Okay, we were expected to pay $1 million with this expected exchange rate. But if we took the risk, we would actually pay how much? 1.2 million. And so therefore we will have paid 200,000 more than expected or less than expected? More than expected, right? And so that's consistent with what we learned about long and short. When you're short something and that something goes up in price or values, the yen unexpectedly appreciated, then did we make or lose money? We lost money, right? And what about the other way around? Okay, so we're short yen in our transaction. If the yen unexpectedly depreciated, okay, so went down in value, did we make or lose money? We made money, right? Why? Again, because we were expected at this exchange rate to pay $1 million. But if we took the risk when the yen unexpectedly depreciated, then we would have ended up paying 800,000, which is 200,000 more than expected or less than expected? Less than expected, right? And so we were short something, that something went down in value, and so therefore we made $200,000. So let's put it all together. Okay, alternative number 2. Yeah. Take on the risk and buy the currency on the due date. Okay, and so what are the advantages relative to alternative number 1? What are the advantages? Well, basically, did we have to come up with any money today if we did this? We didn't, right? You know, taking on the risk, which, by the way, in the context of international finance is called standing naked. Okay, just take the risk. Chances are that's what you do when you go on vacation, right? If you plan a vacation to Europe, say in 3 months, probably you just accept whatever exchange rate exists in 3 months. Okay. So, but in any case, an advantage of this relative to alternative number 1 is, did we have to come up with any money today? We didn't, right? And so have we now regained the credit advantage? We have, right? And relative to alternative number 1, what's a disadvantage? Well, we hedged. We're not, right? We're taking on the risk. So if we put this all together, we could argue that so far, hey, you know, neither one of these choices look that great, right? Either we buy the yen today and we're perfectly hedged, but we have to forego the credit advantage, or we take the risk and we regain the credit advantage, but we're not hedged. So let's move on to alternative number 3. So the next alternative we're going to look at is a forward contract. Okay? So do we need to be long or short a forward yen contract for our hedge? Well, let's look at our transaction, right? On our transaction side, or our widget side, are we long or short yen? We're short yen, right? And so therefore, for our hedge, do we need to be long or short yen? We need to be long, right? We need to be on the opposite side of the transaction. So, do you remember what a forward contract is? This would have been in the previous lecture. Okay, now if you don't, and if you're watching this without having seen the previous lecture, I strongly encourage you, especially from this point forward, I strongly encourage you to go back and watch that lecture, because it'll make a lot more sense what I proceed with today. But in any case, with a forward contract, basically, you know, say I'm a US businessman and I go to a bank and I say, hey, I want to make a deal today about an exchange in the future. So in other words, if I were the business person, I'd go to a bank and say, hey, I want to make a deal today such that in 90 days, I'll agree to pay you a certain number of dollars and you'll owe me 100 million yen. Okay. So that's the forward contract. And specifically, what exchange rate would I use? I'd use the forward rate, right? Which was $0.01 per yen. So the way it looks like is this is me. I'm the guy, say, that's buying the widgets from Japan, and I go to the bank today and I say, hey, let's agree today that I'll give you $1 million in 90 days, and you give me 100 million yen in 90 days. By the way, you'll notice that exchange means that the exchange rate is what? $0.01 per yen, which is, by the way, what the forward or futures rate is. So with that in mind, let's look at our alternatives. Say the spot goes to $0.008 per yen. Okay, so the yen depreciates. Okay, now on the forward side, have we made or lost money? All right, let's think about this. On the forward side, okay, are we long or short yen? We're long, right? You know, now our hedge is on that side. Here's our forward contract. Here's our widgets. That's our transaction. So we're long yen, right? So when you're long something, and that something goes down in value, in this case the yen has depreciated, have we made or lost money? We've lost money, right? Just like buying Apple stock at $550 a share and Apple stock goes down to 500, is that happy face or sad face? That's sad face, right? And why is that the case? Well, with the forward contract, will we have locked in an exchange rate of $0.01 per yen? We would, right? That's what the forward contract is. We would have locked in the fact that, hey, we'll give you $1 million and you give us 100 million yen. But if we had not locked in this forward contract and we could have gone to the open market, then how much would it have cost us in dollars to buy the yen? 800,000, right? And so by having the forward contract, we lost $200,000. Okay. Consistent with what we said earlier. When you're long something and that something goes down in value, have you made or lost money? Well, you've lost money. Okay, so that explains, this side. When the yen depreciated on this side, we lost money. What about on this side? What about on the transaction side? On the transaction side, are we short or long yen? We're short, right? And when you're short something, and that something goes down in price, have you made or lost money? You've made money, right? How much did we make? 200,000, right? Because on this side, with what we owe, we're expecting to pay $1 million. But if we actually only had to pay 800,000, that would be happy face or sad face? That'd be happy face, right? So if we put it all together, on the hedge side with the forward contract, we lost 200,000. But on the transaction side, or the widget side, we made 200,000. And so by having that forward hedged, when the yen depreciated, would there be any unexpected dollar payments? There wouldn't, right? So let's look at the other situation. Imagine if the yen appreciates, unexpectedly appreciates. On the forward side, are we long or short yen? Well, on the forward side, we're on this side, we're long yen. And if the yen appreciated, in other words, it went up in value, when you long something and that something goes up in value, have you made money or lost money? You've made money, right? And so let's see how this works. But basically, with the hedge, what exchange rate, or with the forward contract, what exchange rate have we locked in? $0.01 per yen, right? Which means that to buy the 100 million yen, we're going to have to come up with how many dollars? $1 million, right? But if we didn't have that forward contract and we just went to the open market to see how much, how much money would we need if we just went to the open market and we hadn't locked in this exchange rate? Well, we would have needed $1.2 million, right? So will it have been happy face or sad face, the fact that we had the forward contract? Happy face, right? Basically, it saved us $200,000. So again, you're long something, that something goes up in value, so we're long yen with our forward contract. The yen appreciates, and so we made money on the forward side. But what about on the transaction side? Okay, so here we are with our transaction. Are we short or long yen on this side? We're short, right? And when you're short something and that something goes up in value, have you made money or lost money? You've lost money, right? Why? Because again, you're expected to owe $1 million right here. But if you just left it for the open market, you would have owed, if you left the open market, you would owe $1.2 million, right? So $200,000 more than expected. So if we put it all together, when the yen unexpectedly appreciated, okay, we made money on the forward side, 200,000. We're going, yay, boy, sure, I'm glad we locked in only paying $1 million for that 100 million yen, because If we had had to go to the open market, we would have had to come up with how many dollars? 1.2 million, right? But then on the transaction side, we lost 200,000. So again, when the yen unexpectedly appreciated, were there any unexpected dollar payments? There weren't, right? And so whether the yen appreciated or depreciated unexpectedly, in both scenarios, did we pay anything unexpected with dollars? We didn't, right? So if we put this all together, okay, relative to alternative number 1 and number 2, what are some advantages of the forward contract, of using the forward contract? Well, did we have to come up with any money today? We didn't, right? So have we regained the credit advantage, unlike in alternative number 1? We have, right? And are we also perfectly hedged? We are, right? I mean, as we just went through the whole example, no matter whether the yen unexpectedly appreciates or depreciates, will we pay any unexpected amount of dollars? We won't, right? And so now we've got the best of both worlds. We can have our cake and we can eat it too, right? In this example, not only have we regained the credit advantage, but we're also perfectly hedged. We didn't have both those advantages in both of the first two alternatives, right? So great, but what's a disadvantage of a forward contract? Do you remember? This would rely on your understanding of the previous lecture. Well, to engage in a forward contract, typically what's the minimum amount for an entire contract? Or I should say for a single contract. $1 million, right? It could be 1.1398 million, it could be 2.7 million, it could be any amount, but typically the minimum amount is $1 million. Which suggests that if you're going to be engaged in using a forward contract, are you likely going to be large or small? Probably large, right? And what about your creditworthiness? Is the bank taking a risk by making a deal with you today for an exchange in the future? They are, right? What kind of risk are they taking? Credit risk, right? I mean, you may go under in the next 90 days. And so, therefore, are they more likely to engage in that transaction with their more creditworthy customers? They are, right? So one of the disadvantages of the forward market is that you have to be relatively large and creditworthy as far as accessibility is concerned. So if we summarize it all, we're perfectly hedged, we're using our credit, we've regained our credit advantage, but typically we have to be large and creditworthy. All right, so let's look at alternative number 4, a futures contract. So question number 1, okay, for our hedge, do we have to be long or short a futures yen contract? Well, on what side is our transaction? On the long side or the short side? The short side, right? This is the widgets. We owe 100 million yen. So to hedge, then do we have to be long or short yen futures? We have to be long yen futures. In other words, we have to make a deal today such that in 90 days we will be owed yen. We will be expecting to receive yen with our futures contract. Okay. Now, if you recall, with the futures, it's not like a forward where it's convenient. As long as you do at least $1 million worth, it's convenient what the quantity is. With the futures contract, if you recall, you could only do it in what units? In the case of yen, we saw one contract was 12.5 million yen. Now also, if you recall, for the privilege of engaging in a futures contract, then what did you have to put up? You had to put up margin, right? So what that means is you had to put up a certain amount of money, and we'll go through an example. But when you did put up that money, did that money belong to you? It did, right? And we'll see why. We'll see why in a minute. I'll illustrate what we talked about last time. Okay. But in any case, if it takes 12.5 million yen to have one contract, so 12.5 million yen, but we want to hedge how many yen in total? 100 million yen, right? Okay, so one contract has 12.5 million yen, but we need to hedge 100 million yen. And guess what? I can do this because it's the classroom, right? I made it convenient. Okay, we're lucky. It's exactly divisible. We would need 16 contracts. Okay, so times, 8 contracts, right? Okay, so 12.5 million yen times those 8 contracts comes to 100 million yen. So we would need 8 futures contracts. And by the way, this how many yen contracts do we need to buy? That's a little bit of a misnomer. Okay, do you really buy a futures contract, or do you engage in a futures contract? You engage in it, right? It's not here's $5, give me my broccoli. The second that you enter into a futures contract, does it have any built-in value? It doesn't, right? Because the expected the exchange rate that you lock in is the expected exchange rate. There's no built-in advantage or disadvantage the second you engage in it. In any case, as we discussed last time, you do have to put up, if you will, collateral. It's called margin. So how much margin would we have to put up if it was 4%? I made up that number, 4%. Well, let's take a look. Here we have the 8 contracts, 12.5 million yen for each contract. So that's 100 million yen. The futures rate is $0.01 per yen. So all this multiplied comes to $1 million. And if you have to put up 4%, then that means you have to come up with $40,000 today. Now, that $40,000, is that yours? Does that belong to you? It is, right? That belongs to you, because what we talked about last time was this daily mark-to-market system. So for example, suppose the very next day, the futures price, not the spot price, but the futures price goes from $0.01 per yen to $0.0099 per yen. Okay, so in other words, has the yen, the futures price, has it appreciated or depreciated? The yen's depreciated, right? And for your hedge, for the futures, are you long or short yen? You're long, right? So when you're long something, and that something goes down in value, have you made money or lost money? You've lost money, right? So will you have received a margin call? You would, right? Because what we said was that this daily mark-to-market, what they do is they, on a daily basis, they see how much money you make or lose. And if you lose money, they basically say, all right, well, you need to give us enough money to bring this back up to $40,000. And that's not completely true. I'm missing a wrinkle. They have something called an initial margin and a maintenance margin. Okay, but let's just assume they're both one and the same to keep it simple. Okay. So in any case, you will receive a margin call for the amount that you lost. And we'll calculate how much you lost in just a minute. And let's say how much you lost comes to, I'll make it up for now. Say $5,000. If you sent them the $5,000, then fine, you get to maintain your futures contract. But if you don't, then what happens? Well, because it's tradable, that's why the futures stuff has to be standardized, because it's liquid. They would trade you out, and then they would give you how much money? They'd give you $35,000. So in any case, let's be specific. Okay, let's look at what's going on here. Okay, so the futures price only changes by 1%. Okay, and we've already gone through the logic of why you would receive a margin call. Again, because you're long on the futures yen side, when you're long something, that something goes down in value, have you made or lost money? You've lost money, right? So you receive a margin call. So how much have you lost, right? How much would you have to add to your margin? Well, I mean, basically, it's really no more complicated than figuring out how much you lost if you owned some shares of stuff, right? So suppose you had 10 shares of IBM, say at $100 a share, and then IBM goes over time to say $80 a share. Okay, so let's say you have 10 shares of IBM at $100 a share, and then it goes down in value, it goes to $80 a share. Could I calculate how much I lost? Sure, right? I mean, I could take this difference, 100 minus 80 is 20, so $20 per share. And I would apply that to how many shares? Well, I would apply it to 10 shares, right? So I will have lost $200. So could I use the same logic here? Could I see how much the to my disadvantage the futures price has gone down? Look at the difference, and then apply it to the number of yen or futures contracts I've locked that into? I could, right? So for example, here was the futures price that I locked in. The very next day, the futures price, not the spot, the futures price went to my disadvantage because the yen, the futures price of the yen, had unexpectedly appreciated or depreciated? Depreciated, right? So this difference here in my IBM example is like the $100 and the $80. So the amount I've lost is applied to this many yen, 100 million yen. Okay, so what that means is that in one day, I lost $10,000. So what would happen? Well, as I mentioned before, all right, send us $10,000 to bring your margin back up to 40,000, and then you can keep this futures contract. Or if you don't do that, then sorry, but we're going to have to trade you out of this futures contract, and you'll receive how much? 30,000. But let me ask you something. When you look at these numbers, suppose that we're using the futures just for speculative reasons. So let's say we weren't hedging. Okay, so forget this whole widget example for a minute. Would that suggest that if, as an investor, you decided, well, I think I'll play the futures markets, in specifically the currency markets, currency futures markets, would that suggest that engaging in this type of trading activity, would it suggest high risk, low risk, medium risk? What's your sense? Well, actually, unbelievably high risk. And I'll tell you why. Okay? How much did you have to put up to engage in this contract? $40,000, right? That's the amount that you put up. And when the futures price changed only by 1%, how much money did you have to put up in one day? 10,000, right? So of your 40,000 that you put up originally, how much did you lose in one day? 25%, right? The futures price changed only by 1%, and in one day you lost 25%. What that means is that if you engage in futures prices trading, or futures trading for speculative purposes, you're not using for hedging purposes, then this is unbelievably high risk stuff. And by the way, this is true of derivative securities in general. What's a derivative security? Do you know? A derivative security is one whose value is derived by something else. So in other words, the value of this futures is derived from the yen, the underlying value of the yen. Or you could have options on yen. That's a derivative security also. So trading in derivative securities is very, very risky. Now again, as I mentioned, if we did not mark to market in this example, what would they do? They'd say, all right, well, you originally gave us 40,000, that was your margin. In one day, you lost 25% or 10,000, so now that's down to 30,000. You know, if you're not going to bring it back up to 40, remember, I'm assuming, which is not true, but just for simplicity, I'm assuming the initial margin and the maintenance margin are the same. But if you don't bring it back up to 40, well, we're just going to trade you out. And by the way, here's the rest of what belongs to you. That's the 30,000. So that's basically, you know, using some numbers for the futures contract. Let's go through and check some other issues. Okay. So first of all, are we perfectly hedged, or are we hedged? We are, right? Because, you know, whatever money I make on this side, I'll lose on this side, and vice versa. Okay. However, even though we are hedged, would we have a preference for whether or not the yen appreciated or depreciated in the end to $0.012 per yen or $0.008 per yen? Would we have a preference? Well, let's think about that, right? Under what circumstance, if you've got futures contract here, under what circumstance would you be receiving margin calls? If the yen appreciated or if the yen depreciated? If the yen depreciated, right? And so if 90 days later the the yen goes to $0.008 per yen, you know, eventually the futures price, you know, one day, so day 89, you know, the futures price would be very close to $0.008, and obviously on the day of, it's no longer a futures price, it's a spot price. Okay, so if the yen depreciated, then you will have received margin calls to the tune of how many dollars over time? $200,000, right? Why? Because the rate you locked in was $0.01 per yen. Okay, and in the end, what you have of value is 800,000. So you'd have locked in basically paying $1 million for 100 million yen. But if you hadn't, on the long side, you could have only paid $800,000 for 100 million yen, right? And so basically the difference is 200,000. And it's only on day 90 that you make it up, right? It's only on day 90 when you owe the yen that you're glad that you don't have to come up with $1.2 million to buy the 100 million yen. Why? Because you've locked in $1 million to buy 100 million yen. And so the question is, well, would you rather have a bunch of margin calls over time and then make it up on day 90? Or would you rather not have those margin calls? You'd rather not have those margin calls, right? Let me draw you a quick diagram to show you what I'm talking about. Okay, so let's say this is day 90 and that's day 0. And so basically, over time, okay, you'll have received, you know, minus $200,000. Okay, so it kind of looks like this. Okay, so if this is day 0, this is day 90. By the yen depreciating on the future side, you'll have received a sum total of $200,000 over the 90 days in margin calls. And only on day 90 is that $200,000 made up with the fact that the widgets, you've locked in a favorable exchange rate. So in any case, that's futures, right? So in the end, you're perfectly hedged, right? But you prefer, obviously, that you not receive those those margin calls. So if we put it all together, okay, advantages and disadvantages, well, we could say we're perfectly hedged. Maybe you want to say more or less, because it's possible that you have to wait 90 days until the hedge is complete, if you will. Do we have to come up with any money today? Well, we have to come up with our margin, right? So, but relative to alternative number one, where we had to come up with practically $1 million, have we pretty much regained our credit advantage? We have, right? So we're perfectly hedged, more or less. We've regained our credit advantage to a reasonable degree. What else? What about relative to forwards? Okay, because the forward had both those advantages, right? The forward perfectly hedged and completely regained the credit advantage. Are there any benefits to the futures relative to the forward? Well, what about size? Do you now, is $1 million pretty much the minimum, or is it a lot less? It's a lot less, right? I mean, we're talking about maybe somewhere in the yen case, somewhere between say $10,000 and $20,000 worth. So you don't have to be nearly as big. And what about creditworthiness? Do you even need to go through a credit check? Well, I don't know this for a fact, but I assume you don't, because you have to put up the margin, right? Presumably the margin is large enough to cover any daily loss that you might have, and they have that mark-to-market system. So if we summarize everything, we're perfectly hedged, more or less. We still have our credit advantage, more or less. And now, relative to forwards, we can be relatively small, and we don't have to be creditworthy. Well, what I want to do now is take a little bit of a break. We've got more alternatives to go through, but I want to talk about hedging in the real world. Okay, and I want to ask you the question that basically, in theory and in practice, hedging creates value, and yet some really sophisticated, well-known companies that you and I will have heard of choose deliberately not to hedge, and the question is why. But before I get to that question, first I want to make sure everybody understands why it is that hedging, this avoiding paying more than expected or less than expected, why that creates value in theory. Why does it create value in theory? I mean, after all, you're used to, hey, with greater risk, we require higher returns, right? Well, what if I could tell you, okay, you know what? You're going to have the same required returns, and we're going to reduce your risk. Would that be happy face or sad face? That'd be happy face, right? That'd be great. Hey, same returns, expected returns, required returns. I'm being a little bit loose here, but lower risk. Yeah, that's great, right? And so let's think about this, okay? In the context of our example, so the businessman and buying widgets from Japan, what is our risk? Okay, what business are we in? Well, we're in the widget business, right? I mean, I don't know what we do with these things, right? But we are in the widget business. So if we looked at our company, our assets would basically be, or the risk of what we're engaged in, if you will, would be widget risk, right? And so is there does the market have a perception of risk inherent in the widget industry? They do, right? And so given the risk inherent in this industry, do investors require a specific return? They do, right? So here's my question, okay? Does the market necessarily know, or I guess even if they know, is it true that maybe some companies will choose to hedge their exchange rate risk and others won't, but they're still both subject to widget risk? That's true, right? And whether or not you're a company that happens to hedge your foreign exchange transactions does that change the risk inherent in the widget business? It doesn't, right? I mean, widget business risk is widget business risk. Okay? Exchange rate risk is exchange rate risk. Yeah, those are two, one is not necessarily part of the other. Why is one not necessarily part of the other? Well, because you can choose to hedge out or manage the exchange rate risk, right? And so basically, the theory of why hedging and the theory and the practice of why hedging creates value is because to the extent that you can costlessly hedge exchange rate risk away, okay, but you're not giving up any required returns within the business that you're engaged in, the widget business, then ceteris paribus, would that be similar to what I opened this up with? Hey, given required or expected return, and I get rid of some risk, would that be happy face or sad face? That'd be happy face, right? And so that's the theory of hedging. And yet, okay, in theory and practice, while hedging has these benefits, yet many large and sophisticated companies, they say, you know what, we're not going to hedge. And by the way, in this hedging, it can be a really big deal. Okay, all right, we haven't had a C story for a while. Okay, here's a C story. And look, I don't know this for a fact, but one of the companies that I mean, some of what I'm about to say, I don't know for a fact, but one of the companies that I worked with, okay, they had a big fleet of break bulk ships, and they basically bought them in the early 60s. The Coast Guard lets you keep them for about 25 years, and then maybe they'll give a 5-year extension here and there, etc. But by the mid 80s, this company needed to change, get rid of a lot of their breakbulk ships, and instead, what they did was they ordered 3 container ships, and these ships were about 3 football fields in length. Okay, and as I recall, I could be wrong here, but they either had them built in Japan or Korea. I forget which one. Let's say they had them built in South Korea. Okay, so basically, when you order a ship, this would have been mid-1985. Okay, so 1985. When you order a ship, then I don't know how long it takes to build, but let's say it took a couple years to build. Okay, and so let's say 1987 is delivery of these ships. All right, so when they bid on these ships, the exchange rate was just unlucky, right? They bid obviously in Korean won, right? And in mid-85 is when the dollar peaked. By 87, it had weakened quite a bit, which means if they had negotiated, say, X Korean won, I don't even know what the exchange rate is, so X millions of Korean won, and they didn't do any hedging, then would they owe more dollars than expected or fewer dollars than expected? They would owe more, right? And here's where I'm completely speculating. I could be completely wrong, okay? But in my opinion, or at least in my opinion, there's a possibility that for this company, this was the beginning of the end for them. Okay, that this used to be the largest merchant marine company in the United States, or they had more ships than any other company in the United States. And about, I don't know, maybe a decade later, or 5 years later, again, I forget, but this company went bankrupt. And the reason, and there were other things that went on, but the reason I think this was the beginning of the end is because I've done other work or other cases or whatever. And so, for example, I wrote a case, it was with Northwest, where they had the biggest purchase of aircraft ever at the time. And doing sensitivity analysis with whether it was positive net present value or zero or negative or whatever, what do you think was the biggest factor that made it positive or negative NPV? And I'll give you some multiple choice. maybe unexpectedly higher fuel prices, maybe unexpectedly higher labor costs, um, the negotiations in how much you paid for the plane. What's that last one? Okay, that was a huge deal, whether it was overpaid or underpaid. And so in any case, the shipping company I was talking about, they had a policy of not hedging. At least that's my understanding. I could be wrong about that. So they had a policy of not hedging. And so in my opinion, there's the possibility that this was the beginning of the end for them. So the bottom line is that hedging, this is a big deal. And yet some companies deliberately choose not to hedge. And I mean they have the resources, they have the know-how, they're big enough, etc., etc. They're exposed to foreign exchange risk. They understand the theory behind it, they understand the practice behind it, and yet they choose not to hedge. Can you think of why? Well, I'll tell you another story to answer the question. Okay, have any of you ever heard of Barings Bank? Okay, well, Barings Bank used to be one of the oldest merchant banks in the whole world. And I think it was the oldest in England. And in any case, in 1995, this guy by the name of Nick Leeson, okay, I'm looking at an old article here. This guy by the name of Nick Leeson, you've probably heard of rogue traders, on an unauthorized basis, he decided to engage in trades in the name of Barings Banks using, guess what? Derivative securities. Okay, remember some of that speculation I was talking about? And in the process of just a few months, he ended up losing the equivalent of $1.3, $1.4 billion. So here you have the oldest bank in England, and after this whole episode of just a few months of engaging in this speculative kind of activity, and we've already seen how risky this stuff is, guess how much, the bank went under, guess how much it was sold for in the end? £1. Okay, it was sold for £1. And so it basically just got crippled to its knees. Now, one of the duties of a board of directors is to ensure that there are controls in place to identify, measure, and control risk. Okay, and the kind of risk that I'm talking about in this example is something that is called internal control risk. Okay, in other words, there need to be mechanisms in place such that the board of directors can be assured that rogue trading is not going to happen. Now, it's really tempting when a rogue trader is making money. Is it tempting for management and maybe even the board to sort of, okay, great, at least relative to losing a ton of money? Is it tempting to not really pry deeply into it? It probably is, right? But in reality, is that just as much of a red flag? It is, right? And so many companies have these internal control risk mechanisms in place. But some companies say, you know what, even with these controls that we could put in place and do have in place and so forth, we still don't trust it. Okay? And so we're just going to not hedge. Why? Because if we hedge, or that means that our employees or someone on our behalf has access to these kind of securities, and it's just not worth the risk. And so therefore, many sophisticated firms that you and I will have heard of choose to hedge. They trust their internal risk control systems. But other companies say, no, it's just too much of a risk. So that's a little bit on hedging in the real world. So let's get to alternative number 5. And that is to use a options contract. Okay, now do you remember what an option is? Well, this is from the previous lecture. And an option, basically, a call option, say, gives you the right but not the obligation to buy, if it was a yen call option, a certain number of yen at a pre-agreed exchange rate on or before an agreed upon date. And a put option gives you the right but not the obligation to sell a certain amount of yen, etc., etc. So here's my question. Okay, remember our transaction, we're on this side with short yen. Those are our widgets. So would we want a call or a put option? Would we want the right but not the obligation to buy yen? And if we bought yen, would we own yen or owe yen? We'd own it, right? So would we want that, or would we want the right but not the obligation to sell yen? We'd want a call option, right? Because we want to own the yen. We want to be on that side, right? So we need to be long yen, therefore we want a call option. Okay. So on the Philadelphia exchange, yen options are traded in units of 6.25 million yen. Okay, I don't know why, but it's half of what the futures contract size is. So we would need how many of these contracts? We'd need 16, right? So that's what would come to 100 million yen. So let's say you buy a call option, and here, are you buying? You are, right? Here it is, like, here's $5, give me my broccoli. Now I have something of value. The broccoli is something of value, right? So here's, in the example I've made up, here's $2,400. Give me a piece of paper that says I have the right, but not the obligation, to buy, with 16 contracts, 100 million yen for $1 million on or before a specific date. So let's imagine this cost you $2,400. So that $2,400, does that belong to you anymore, or is that gone? That's gone, right? That no longer belongs to you. It's not like the futures where you're putting up the margin. Now suppose a few days later, the yen, in this example, has unexpectedly appreciated or depreciated. It's appreciated, right? At least relative to the 0.01. Okay? And so the intrinsic value of the option, that is, well, if I exercised it right now today, how much money would I have saved by the fact that I've locked in, or have the right but not the obligation, for a specific exchange rate? So in other words, in this example, okay, on the open market, I could buy yen for $0.011, but my option says I have the right but not the obligation to only spend $0.01. So will I have been happy or sad that I had the option? Happy, right? Because, well, on the open, with what I've locked in, I'm at an advantage relative to the market. So how many dollars will this have saved me? Well, similar to what we said before, look at the difference and apply it to the number of yen that you can do this for. So if I look at this difference, it will have saved me $100,000. So we would say that the intrinsic value of the option in that example is $100,000. Now what if the spot a few days later goes down? So it goes to $0.0099 per yen. Would you, remember, you have the right but not the obligation to buy the yen for $0.01, but on the open market, you would only have to spend $0.0099 per yen. So which of those rates would you use? Well, presumably the one that was cheaper to you, right? And which one's cheaper to you? Well, this one here on the open market. Therefore, would you be using the option? You wouldn't, right? So what would the intrinsic value of the option be? Would it be negative? No, there's no such thing as negative intrinsic value for an option. Why? Because you're not locked in. You have the right, but not the obligation. And so the intrinsic value would be 0. So let's go through these alternatives, or when the yen appreciates and depreciates. Okay, so imagine the yen depreciates. Okay, so remember on the option side, are we long or short yen? We're long, right? And when you're long something, that something goes down in value. Have you made money or lost money? You've lost money, right? But what's the most we can lose with the option apart from its cost? Zero, right? There's no negative intrinsic value. So when the yen depreciates, well, there's the cost of the option, and I've made that up. The intrinsic value is zero. Okay, so on the call side, we lost $2,400, but on the transaction side, okay, so on this side, you're short yen. The yen depreciates. When you're short something and that something goes down in value, have you made a lot of money or lost money? You've lost money, right? Nope. You've gained money, right? When you're short something and something goes down in value, you've gained money. How much have you gained? Well, you've gained 200,000, right? Because why? Well, you expected to pay 100 million yen, but if you only had to pay 800,000, then you'd gain money. So on the transaction side, we gained 200,000. So put that together, and you've gained 197.6. So let's look at the yen appreciating now. Okay, so the spot goes to 0.012. Did you make money or lose money with the call option? Well, of course, you had to pay $2,400, right? But is there any intrinsic value? So the option is saying you have the right, but not the obligation to only spend $0.01 to buy 100 million yen. Or you could go to the open market and spend 0.012. Now, does the option have intrinsic value? It does, right? As we calculated before, it would have $200,000 in intrinsic value. So on the call option side, we made 197.6, but what about on the transaction side? You short something, that something goes up in value. Have you made or you lost money? You've lost money, right? And as we saw earlier, we lost 200,000. So if we put all that together, the net effect is minus 2,400. So if we put it all together, okay, if the yen appreciates, we lose 2,400. If the yen depreciates, we gain 197,600. So first of all, is this a perfect hedge? Well, what would these two numbers have to be? This guy right here, that 2,400 loss, and this 197,600 gain, what would those have to be to say it was a perfect hedge? It'd have to be 0 and 0, right? There'd have to be nothing that you pay more than expected or less than expected, no matter what happened to the unexpected movements of the yen. So it's not a perfect hedge. And so my question, say relative to a forward contract, hey, let's say you're large enough and you're creditworthy enough so you have access to the forward market. Okay, what would you do? Would you hedge with this option, or would you hedge with a forward contract? Now there is I'll admit, hoping you aren't spotted, there is a floor. That's FLAW, a floor in the numbers I made up, and specifically the 2,400. I'll tell you what the floor is in a minute, but basically, let me put it this way. Okay, what business are you in? Well, you're in the widget business, right? Now, do shareholders want you to engage in risk? Well, some of you might say, no, they want us, Well, if shareholders do not want you to engage in risk, then if I invested in Apple, what's the safest thing Apple could do with the money that I did when I invested in Apple? They could invest it all in US T-bills, say, right? Well, some might argue how safe that is, but that's another subject. So in any case, do I, as a shareholder, do I want Apple to use the money that I give them as a shareholder to invest in T-bills? No. So do I want Apple to engage in risk? Well, yeah, of course. Do I want them to engage in any risk, or does it matter what kind of risk? Would I want Apple to engage in getting into the fish farm business? No. In fact, if they announce tomorrow, hey, we're going to get into the fish farm business, what do you think would happen to that announcement with Apple's stock price? Well, it'd probably plummet, right? Why? Well, because that's not their area of expertise. So do shareholders want companies to engage in risk? Yes. Does it matter which risk? Yes. They want them to engage in risks in their area of expertise. Okay, so to the extent that the area that they're in is an unlevel playing field, but they're on top, there's an expectation, not a guarantee, but an expectation that they can do better with your money than you can on a risk-adjusted basis. So here's my question. If this was a forward contract, this number here, the 2,400 loss, and that number there, the 197,600 gain, those would be 0, 0. But with the option, we've got a minus 2,400 and a plus 197,600, and I intentionally made the numbers look tempting. Is the option relatively risky compared to the forward? It is, right? The forward is no risk. So if you're in the widget business and you're not in the exchange rate business, do shareholders want you to engage in exchange rate risk? They don't, right? And so therefore, if you had a choice, what would be better, the forward or the options? The option, right? I mean, the forward, right? Okay, the one without the risk, if you have a choice. So we'll ask in a minute, what's the real advantage of hedging with options? But I'll admit to my flaw now, and that is that at the very beginning I said that the yen unexpectedly appreciates or depreciates with what probability? 50-50, right? So the fact that I get these numbers here, my expected cash flow is 0.5 times minus 2,400 plus 0.5 times plus 197,600. So in other words, this price of $2,400 for the option was way underpriced for the numbers I made up. If it had been efficiently priced, then it wouldn't have looked nearly this tempting. Okay, but in any case, the big picture concept is that with shareholders, they do or they do not want you to engage in risk. They do, but does it matter what that risk is? Yeah, areas of your expertise. So if taking on exchange rate risk is outside of your area of expertise and you have the choice to relatively costlessly avoid that risk, is that what they would want? They would, right? And so if that's the case, then under what circumstances might, even though it's not a perfect hedge, under what circumstance might you use options as a hedge? Any thoughts? Well, what about this? Okay, here's another example. Suppose you're a U.S. construction company, okay, and you're building on a contract in Japan. So let's say Tokyo, okay. So Tokyo says to you, all right, hey, come build a building. We'll take bids, okay, and we'll announce the winner of the bid, in 3 months. Okay, so first of all, with that example, with your transaction, have you set up an accounts receivable or an accounts payable? Well, an accounts receivable, right? Because will Tokyo pay you to build the building if you win the bid? They will, right? So let's say, I'll keep the numbers the same. Okay, let's say your transaction, okay, is you build 100 million yen, okay, for the building. So you're saying, all right, well, if you pick us, you'll owe us 100 million yen and we'll build the building, okay? But 3 months later, as far as dollars is concerned, would you be getting, and you win the bid, would you be getting an unexpected more dollars or fewer dollars? You would, right? So if you were going to hedge, what side would you hedge on? The same side or the opposite side? The opposite side, right? So somehow you would have to set up your hedge, 100 million yen accounts payable, okay, on the other side, okay. But here's the problem, okay. 3 months, let's say you hedged with a forward contract, and 3 months later you lose the bid. Okay, so all of this goes away. Are you now completely exposed on your forward side? You are, right? Because you have what's called a contingent situation here. Maybe you win the bid, maybe you don't win the bid. If you hedged with a forward contract, you'd be completely exposed because you'd have nothing here and everything here, which means you'd either make or lose a lot of money. You'd be taking on a lot of risk. Okay, but instead, if you engaged in a although not a perfect hedge, with an options contract on this side, then you put much more of a floor on the most you could lose. You do, right? I mean, basically, the most you could lose would be the cost of the option. And you might get lucky and you might make some money too, right? With the exchange rate risk. And so the real advantage of hedging with options would be under contingent situations, where maybe you're going to be involved in this transaction and maybe you're not. So if we put it all together, okay, well, we've got the advantage of the options hedge is it's good for what kind of situations? It's good for contingent situations. Disadvantages? Well, is it a perfect hedge? It's not, right? And by the way, this is true of futures also. With futures and options, do you think they're available for all currencies in the world or primarily the less risky ones? Primarily the less risky ones, right? They're not available for all currencies in the world. I could be wrong, but I doubt there's a futures market for the, I don't know, I don't know what country to pick. I was going to say the Russian ruble, but maybe there is one for that because they're such a large economy. But in any case, they don't exist for all currencies. So if we summarize everything so far, well, forwards and futures, they provide perfect hedges, more or less. I know there's a little bit of a more or less with the future stuff. Forward market, however, generally limited to what? Large and creditworthy customers, right? Can you be smaller with the future if you're a futures? You can, right? You don't have to have at least $1 million. Okay, so futures market is now more accessible. If we look at the options side, okay, big advantage is for contingent situations. All right, so you're not left standing naked or totally exposed with that forward contract example I gave. But the options market is or is not a perfect hedge. It's not, right? The options market is not a perfect hedge. And futures and options available for all currencies or less risky currencies. Less risky currencies, right? And so that brings us to our next alternative. Alternative number 6, something called a money market hedge. Okay. Now, does anyone know what a money market hedge is? Well, it's a definition, right? This is not understanding. Either you know it or you don't know it. So, hey, tell you what, I'll tell you what it is. Okay. A money market hedge is basically borrowing and lending in different currencies. So let's put this in the context of our example. And to do this, I'm going to go all the way back to alternative number 1. Okay? If you recall alternative number 1, what we had to do was come up with 99, almost $1 million today, convert it to today's rate to get 99.4 million yen. And then what did we do with those yen? We lent it to the Japanese government by investing in a what? a yen T-bill, right? Such that at 2.5% in 90 days, they would owe us what? 100 million yen, right? So here's our transaction, here's the widgets, and alternative number one is we create an accounts receivable by having the Japanese owe us 100 million yen in 90 days. But what was the disadvantage to all of that? Well, we were perfectly hedged, but we lost the credit advantage, okay? And so what would be a solution? How we had to come up with practically $1 million a day, $993,000 roughly. What could we do if we wanted to regain the credit advantage? Well, what do you do when you need credit? Do you borrow money? You do, right? So what we could do is we could borrow this money, right? And that's consistent with the definition of money market hedge, right? We could borrow dollars and lend yen. So the question is, well, what rate would we be borrowing at? Well, if we look at the various interest rates that I gave you earlier on, these were the interest rates we made up: 3%, 90-day rate, 2.5%. T-bill, U.S., Japanese prime, U.S. prime, Japanese prime, etc. Okay, so we're an American. We're borrowing dollars. So first of all, would either the Japanese rates be relevant or irrelevant? Irrelevant, right? Because we're borrowing dollars. So we have a choice of this U.S. 90-day T rate or U.S. prime rate. What would apply to us? The prime rate, right? Of those two, the only choice, it has to be the prime rate. Why? Because are we the government? We're not, right? We're the widget business people. Okay, so this 90-day T rate is the government. So 6%. So if we borrow this much today, 6%, 90 days later, how much would we owe? Well, time value money stuff. Again, if this is not crystal clear, then you can go to the time value money lecture from the corporate finance series. But basically the future value, just real quick, why do we take this 6% divided by 4? Well, because by convention, that's how they communicate the exchange rate. By convention, this is an annualized number, and to turn it into an effective 90-day rate, the only first step you can do with that 6% is divided by 4, because there are about 40, 90 days in a 1-year period. At least that's what we're assuming. So in any case, borrow this much today at 6%, pay. Now we're looking at a little bit over $1 million, about $7,500 over $1 million. Now, how much were we expecting to pay for the widgets? If you recall, the expected exchange rate was $0.01 per yen. So if this exchange rate applied to 100 million yen, that came to what? $1 million, right? So we were expecting to pay $1 million. But if we engage in this money market hedge, in the end, how much are we having to come up with? Well, about $7,500 over $1 million, right? And so we would say that the cost of the hedge is about $7,500. So here's my question for you. What is driving this cost? What is driving this cost? Well, remember, okay, at what rate are we lending the yen? Okay, that was at 2.5%, right? And at what rate are we borrowing dollars? That was 6%, right? So we're lending yen at 2.5%, and we're borrowing dollars at 6%. So the fact that 6% is greater than 2.5%, okay, so the fact that we're borrowing at this number and lending at this number, is that what is driving that cost? It would appear so, right? However, that's not completely correct, really. In fact, there's really another layer of thinking, because if we had somehow been able to borrow at 3%, and lend at 2.5%. Okay, so if we'd been able to get this rate instead of the 6, then guess what the cost of the hedge would have been? Would have been 0. Why is that? Well, does this 3% look familiar? Well, the 3% was the 90-day US T-bill rate, right? And the 2.5% was the 90-day Japanese T-bill rate, right? And if interest rate parity had held, then would the expected exchange rate be such that you were indifferent between the two? It would have, right? So if interest rate parity had held, there wouldn't have been a cost. So what drives the cost is not, in a direct sense, the fact that one number is bigger than another number. What drives the cost is the relative risk. Okay? If you, as the borrower, are higher risk than who you're lending it to, then you're going to have a higher cost or a lower cost for your hedge. A higher cost, right? So let me give you another example just to maybe really drive this point home, okay? Whenever you lend money to a government, is that necessarily at or close to 0 risk? It's not, right? I mean, suppose you lent, sorry to pick on Zimbabwe, but suppose you have the choice. Well, I can either lend money to Zimbabwe or I can lend money to IBM. Okay, so IBM, they don't have the right to print money, etc. And well, nor does Zimbabwe now. But in any case, who would you perceive of as to being the higher risk, the Zimbabwean government or IBM? The Zimbabwean government, right? So yeah, you can engage in a money market hedge with any currency. I mean, to the extent that a government is willing to borrow money from you. Okay, however, suppose that you, the business person, you, the widget person, were lower risk than the government that you were lending to. Then instead of say a 7,500 cost of hedge, that 7,500, would that now be a negative number? It would, right? Because now you're changing this sign. If you as the borrower are lower risk than who you're lending to, then the cost of the hedge is going to be negative. But is that like a free lunch? No. No, it's not a free lunch, because now you're taking on what kind of risk? You're taking on credit risk, right? You're taking on the fact that, hey, this government that I lent money to, they may not pay me back, right? And so it matters who you create, or which entity you create this money market hedge with. So if we put this all together, okay, as far as pros and cons of money market hedge, well, an advantage is, well, are you hedged? Does it work? And if we engage in a money market hedge, will we have created something equal and opposite on this side? We will have, right? And with a money market hedge, have you regained the credit advantage? You have, right? And with a money market hedge, can you create that with any currency? You can, right? Was that true of futures and options? Did futures and options exist in all currencies? They don't, right? They exist for the relatively less risky currencies. And so, but a disadvantage, or what you have to be careful about, is that you're not exchanging one risk for another, that you're not exchanging exchange rate risk for credit risk. It matters which entity you're lending the money to create the money market hedge. Okay, well, another alternative number 7, is called risk shifting. And what do you think risk shifting is? Well, basically, with the 100 million yen for the widgets example, you're telling the Japanese supplier, no, do not bill me in yen. Tell me what I owe you in dollars. So basically, you refuse to deal in any currency other than your own. Now, if the Japanese supplier cannot, hedge that risk for whatever reason, if they're taking on risk that they cannot get rid of, then ceteris paribus, all else being equal, what might they do to their prices? They might raise them, right? And so essentially, you can refuse to deal in any currency other than your own, but you might pay for that privilege. Another one, risk sharing. Okay, what do you think risk sharing is? Well, basically, risk sharing is you say, all right, well, this is the expected exchange rate. Okay, so imagine, whatever this is, let's say this is the expected exchange rate. And let's say you create this band on each side. Okay, maybe it's plus 1% and minus 1% or whatever. Okay, and risk sharing is saying, well, if the actual exchange rate ends up here or it ends up there, so in other words, it ends up within the band, then all right, fine, we've got a small winner and a small loser. But if it comes outside of this band, do we now have a big winner and a big loser? We do, right? And if it goes outside of this band, basically, all right, well, the winner agrees to give up his or her winnings such that there's neither a winner or loser. So that's risk sharing, and I can tell you a story about that. It's not a sea story, but it's a story, and it's not with exchange rates. But I remember when my parents, they retired to North Carolina. They've had this property, and they were finally going to build on it. And this was in 91, 92 time period. And at the time, the price of lumber was just really fluctuating. It was very volatile. And so typically you would go to a contractor and he or she would build your house, but they would have to presumably build into the price of the house the risk of what lumber cost. And my dad basically made a deal with the contractor that was similar to this. He said, look, if here's the lumber, the price of lumber, and why don't we say that if it's unexpectedly high, then if it goes outside of this band, then I'll kick in some more and we'll bring it down before. If it's unexpectedly low, you kick in some more and we'll bring it back up to this level. And so basically we'll just share the risk. And the contractor went, wow, that's great. Yeah, because I don't want to take on this risk. It's win for me and it's a win for you. And so that's basically what risk sharing is. If the exchange rate stays within a certain range, fine, you got a small winner and a small loser. But if it goes outside of a particular range, then let's bring it back down to having neither a winner or a loser, at least with respect to what was expected. All right, so there's one last thing I want to bring up, and that's exposure netting. And let me bring it up with an example. Okay, imagine I have operations. I'm an American firm. I have operations in Germany, where I have an accounts receivable of €1 million, and I have operations in France, where I have an accounts payable of €800,000. Now, if I wanted to, could I create a €1 million hedge here and a €800,000 hedge right there? I could, right? Sure, I could do that. Why not? But could I also sort of net these out where this offsets that and I'm left with a net of €200,000 and then just have a hedge on this side for 200,000? I could, right? And that would be something called exposure netting. And what's an advantage of exposure netting? Well, an advantage of exposure netting is basically, well, which one is going to have fewer transaction costs? If I hedge 800,000 here and I hedge $1 million here, or hedging just 200,000 there. And of course, just this one hedge for €200,000 is going to have lower transaction costs. And so that's basically what exposure netting is. So this essentially concludes this lecture. The goal was to manage exchange rate risk in the short term. So like I said, we started off this class understanding why the dollar goes up and down in value, or why other currencies go up and down in value. So get a really good understanding of that risk. In the second half of this course, we're looking at managing this risk. Managing it not only in the short term, which is what we did today, but moving forward, managing it in the long term. And by the way, not just managing it, but looking for risk opportunities, if you will, that exist out there. So in any case, as always, I hope this was a really good learning experience, and I hope to see you at the next lecture. Take care. Bye-bye.